What's going on, James?
Not much. How's it going?
Pretty good, pretty good. So feel free to anyone that has questions, feel free to just drop a comment and we'll be happy to answer some of them.
Yeah, maybe we could, while we wait for some questions to come in, talk about how the various systems that we might have been trading today, helped us navigate the, um, you know, relatively tight range and compression of volatility.
Yeah, I can. Do you want me to talk for a minute?
Sure. Yeah, and then I
Yeah.
can share my
So
system and how that worked.
and before I say that, one of the things I'm really a big proponent in, excuse me one second, sometimes simplifying what you're doing trading wise is sometimes the best avenue. Apologize, my throat's been a little out there, but sometimes simplifying your trading in the sense of understanding just stop entries in the overall direction. In other words, the market cycle. You hear Al talk about this all the time in the trading room. He trades a lot with limit orders, but he's always looking for what's the stop entry? Who is, who's owning the market, the bulls or the bears? And if I just pull up today's chart really quick, James, can you see my screen?
Absolutely. Got it.
Awesome. So when you look at this chart, one of the things when you think about anywhere of today, so here was the first bar of the day, and the one thing that strikes me is just look at the moving average. We have all these bars above the moving average. Sure, it's climactic, but look at every one of these sell-offs. Bar 72 yesterday sold off for one bar, sideways for three. Bar one outside up, it's a climactic bar. But even if some traders would sell below two or the close of three, but a lot of those traders that are selling here, they're just traders that are aggressive, hoping for the downside breakout, but they fully expect this to happen. And the point is, if you're going to fade a tight channel or if you're going to look for a reversal, you need a strong trend line break. Bar 7 is not a strong trend line break right here. It just touched the moving average. So all those bulls get out here. And when you just look at this chart, even here, tight bear channel, a lot of traders don't want to buy. And because it's FOMC, it's understandable to wait. But I think the biggest thing about today, when you see this big of a bar, sure, you can say, oh, it's climactic, I'm going to sell it. But that's really a bad idea. I think a lot of traders mess up their trading just because they try and fade too many things instead of where's the nearest break, what is the most impactful breakout or the market direction, and just entering on a stop. And the reality is, even though it seems crazy, this bar is, I think it was 24 points. Okay, yeah, it was 24 points. So if you buy above this bar and put a stop all the way down here, even if you put it at the midpoint, what's the real chances that on the open of bar two, this bar, in other words, what's the real chances it's going to just sell off to the midpoint in seconds? It's probably not. At worst, it's probably just going to stall and then allow you out break even. But even if a trader bought here, put a stop somewhere down here, and traded small, where is a logical place for the bears to sell? It's really hard to hold on to this trade because at some point, traders naturally just want to take profits, the July high. But when you just look at this market, even, if this was just let's pretend the range wasn't huge. Is there any reason to sell any one of these bars for a swing? Of course not. And then eventually, what do traders do? It's what Al talks about all the time. Buy the close, get out below bear bar, closing on its midpoint. And so the biggest thing, even though I thought a lot of today was rather boring, even if you go back to yesterday for just 1 second, and James, I'll turn it over to you.
Hmm.
Even if you go back to yesterday, I think one of the biggest things is you can find any move that's going to have a decent swing will always have a stop entry. So if you sold below bar 1 and then bar 4 reverses up, you've got to get out. If you buy above bar 4, you can get out below bar 12, but even 12, what's realistic to happen if you sell below 12 yesterday? At best, the market's probably going to go sideways. And because of that, traders wait for bar 12 to fail and then reverse up, and then they buy the pullback. But when you look at every one of these bars, I like to always ask myself, where is a credible stop entry against the trend? And there's really not one. Even here, minor reversal, 32, minor reversal. These bear bars here, probably going to be a minor reversal. And every one of these was just minor all the way up. And I'll go back to the screen now. I think that is one of the single biggest things, whether it's discretionary trading, whether it's systematic trading. If you can figure out a way to apply, and every stop entry is a breakout, but if you can figure out a way to apply what direction, if I had, Al always talks about it, if I had to be in the market, long or short right now, which direction makes more sense? There's usually going to be one that slightly favors the other, especially, obviously in a tight trading range, it's not ideal, but I don't care if you're trading a breakout system, and if the market's above the moving average, whether you're trading a breakout system or you're buying a pullback of a breakout, or if you're buying above a bar, all of them should lead to buys. James, I'll let you
Yeah,
take it from there.
Yeah, I think that thinking about it systematically makes it much easier. A lot of the folks in Systems Academy have coded or have rules, methods for defining what the always in direction is, and their systems will filter based on that. So you can do the same thing based on market regime. So if the 5-minute chart is above the 200 moving average, basically the 60-minute EMA, or intraday 5-minute EMA. Even dips like we saw yesterday, on the open, strong impulse, apparently impulsive moves below the EMA, which are really just tests of the 200 moving average. Those are not even that. That was a cell vacuum test of the previous days. Failed bear breakout. Around so the bar 43. That was the
bar
last
43 yesterday.
Sorry, 2 days ago. So that
My
cell
fault.
vacuum
Yeah.
that cell vacuum test yesterday on the open. That came down and let out any of the sellers who were attempting to fade and anticipating a trading range day, and got stuck in the bull move into the end of the day. Outside of that, there's the cell vacuum test, and still in strong bullish regime.
Absolutely. And James, one thing you just said here that's important is people look at these bars as breakout bars, and it's true, they are breakout bars. But one of the things you always have to weigh with trading is the risk reward. Everything you do has a risk and a reward associated to it. And those are the two variables you control. Obviously, probability is another factor. When you're selling the close of 1 or 2, there's only one reason you're selling the close of 1 or 2. You're selling it in the hopes that the market just races down. In other words, you're hoping to catch a windfall of a profit. It's kind of like buying the FOMC bar right here. You're just hoping that the market just races up. And because of that, a lot of traders understand if they're selling here, the smart traders know that they're selling momentum and they know that that momentum could end at any moment and it can end quickly. So, what are they going to do? They see the tail on one and the tail on two. They see that as a pullback on a smaller time frame. So, that's kind of strike one. Then they see bar three. Bar three went straight up instead of straight down. So, a lot of traders, when they're short here, sure, in theory, they have a stop up here, but the reality is they have more, it's more of a momentum stop or a time stop. If the market doesn't continue to race down, they're going to start to drag their protective stop, if you will, closer and closer to the market price. So what does that mean? They sell the close of two and bar three doesn't race down. They conclude that maybe bar two had a 60% chance of going lower. But in other words, maybe bar two had a 60% chance of getting a second leg down. In other words, the first reversal up failing. But when bar three went up and then pulled back right here, a lot of those traders, that was that first pullback attempt. And they're going to be really quick to get out because they understand on the open, 50% chance there's reversal. And that's why this bar happened. You could say the same thing here. It's not a great buy. It's a bull channel, breakout of a bull channel, test of the highs. But a trader that bought here, they see the tail above this bar and they're not naive to that. And then when this bar has another tail up here, they see it as two legs up, rally, pullback, rally, pullback. And a lot of those bulls who are long, what do you think they're going to do? They're lightening their positions rather quickly because they're anticipating this, a wedge, 1, 2, 3, and then everybody gets out. Whenever you're trading breakouts, you have to realize it's like right here. You can't, if you're short here, a lot of traders will sell this. There's logic to it, but they're not selling down here because of the risk reward. And it's the same thing here. When you're trading breakouts, you can't, if you're short all the way down here, you have to ask where your stop is. And if it's all the way up here, you've got to have an honest conversation with what's the real probability that the market's going all the way down here before it does the opposite. And that's why a lot of traders, if they were short and they see a big bull bar, they're going to be really quick to trying to get out break even.
Yeah, the DJ Kanu has a good question in the chat, which kind of dovetails with this conversation about how to assess the strength and probability of continuation for trend resumption for breakouts. Because really, the most useful system to have is a breakout system because it determines, or it helps you determine where you are in the market cycle. Because if breakouts are not getting major extension beyond previous swing points, then odds are you're in at least a channel, if not a trading range phase, versus a breakout phase where you're going to get, swing, pivot highs, swing highs, well above previous swing points because you're starting a new market cycle. The strength and momentum is much stronger at that point. So, having a system which can help you identify those points is useful both for identifying trade setups, but also for keeping you honest about where you are in the market cycle. So I can share my screen real quick, and we can answer DJ's question as well. So this is today's chart with the trend and trading range signals on it. And here we have a trend bar on the open, but it's an outside bar. So that's, has good odds for at least getting a second leg at some point, but odds for a deep pullback because it's an outside bar. So outside bars on the open typically lead to at least sideways price action. But if they get a breakout and follow through, then you're typically going to get support. If it's bull breakout, support at the previous high where people where bears were fading. Here bears were fading there. Obviously we made it down, but then this system generated buy signal here, buy signals all the way up to the high. And one of the things that I wanted to to comment on in relationship to DJ's question. When you're developing a system and you get, to the point where you're developing actual signals, that's well beyond the point where you have done a study to determine how whatever idea you want to investigate expresses itself as a first principle of price action in the market. So if you're studying, for example, like the example you give, the micro gap, um, you would be doing extensive study on how micro gaps operate. So like this is an outside bar that generates a micro gap with a weak second bar and a strong third bar for the close. So here's your, actually I can turn on my micro gap indicator. So here's your strong micro gap, and then the signal indicator that I wrote is showing this as potential support, because you'll get bears fading above this, and when you get a breakout, then that typically generates a layer of support between there and the high of the micro gap. So anywhere between here, or sometimes a 50% is a reasonable place to start entering. So yeah, that would have been right around the tail there. So the idea of doing a research study on something like a micro gap or breakout and follow through, or any of the different varieties of breakout setups that you could use to filter for potential trend resumption trades, you would basically identify all of those on the chart and say, today we had one micro gap, 2, 3, 4, 5, 6, and then the giant one, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So 17 micro gaps. How many of them generated tradable setups, and those that failed, what caused them to fail? And so basically you're putting together a catalog of all of the different nuances surrounding that idea that you want to do the study on. And then you just build your Excel spreadsheet and you catalog all of those things to determine which ones have the most significant effect on how those setups actually, or how that first principle of the breakout that creates a micro gap actually expresses as a potential trade setup. And because the setup then integrates whichever variables you identify to be the highest probability contributors to the success or failure of that setup. And I say failure because whichever characteristics you determine to be more related to the high probability of failure can be used to actually later on at some point build a mean reversion system. Because once you know that these characteristics actually make it a high probability for failure setup, then you can trade it for fades and mean reversion. So you get both at that point. But that's the difference between a study and backtesting. Backtesting would be actually going back and
There
sorry
we go,
about that.
James. We missed you for a second. You'd say back testing would be going back and what?
Oh, sorry. Backtesting, yeah, the difference between backtesting and conducting a study. Backtesting is actually assessing the performance of a complete system, which you've designed and want to actually get the performance statistics for metrics for, versus a study, which is acquiring a deeper understanding of some first principle of price action and how you could actually then turn that into a system, which you would then conduct the backtesting on.
It's a very good answer.
So they're two very different parts of the system design process, but they're both integral to developing a deployable system.
Absolutely.
Brad, when you were doing research for your systems design, did you do multiple market studies, or did you have a good sense of where you wanted to begin and to kind of just run with the idea that you came in with.
Yeah. So James, when you say just repeat the question so I make sure I understood you fully.
Yeah. I'll stop sharing here.
Yeah, you're good.
Um, when you decided that you were going, which system you were going to start building around, did you do multiple market studies to assess, which one you wanted to, uh, whether it was breakout and follow through or microgapped or whatever? Did you do multiple studies, or did you kind of settle on one and do an initial study and then start designing a system?
So I primarily settled on one. It really started with a kind of micro channel strategy. And then it pretty much settled into more or less refining how I'm counting legs, and especially on the open. In other words, one of them was primarily when you're watching the mini, whether that's the spy, anything with the open, basically. And the first thing I did, or one of the things I did, was trying to find basically an always in flip. That's kind of what it morphed into, if you will.
Hmm.
Trying to find a breakout with follow through, crossing the moving average that was strong enough for a second leg. In other words, which basically gets into, sometimes what I talk about all the time, waiting for the opening swing to begin. And usually, in other words, instead of taking the double bottom or the double top, waiting for the actual breakout with follow through to occur. And usually, an ideal one, the easiest one was crossing the moving average. And for me, as far as I tried, I thought a lot about, do I buy the close? Do I buy a pullback? How exactly? And I concluded with allowing myself to do both. So in other words, if it's if it's reasonably strong, enter on the close, trade small enough to where you can scale in on a pullback. If the breakout gets stronger, add to it. If it's more of a trading range, then wait for a test of the breakout point.
Nice. Yeah, you said something there, which only arises from either deep uh, experience of price action and watching the open, or from a study, which is you concluded that it was the breakout and follow through, and the most indicative way of finding that always in flip was the strong breakout and follow through across the EMA. um, and that's a huge data point that most people will miss. Like if it's still, for example, inside the opening range up to that point, and it's not a breakout of the opening range high, but it's strong enough to flip the always in direction. Some folks will even fade it, because they anticipate the opening range will continue to be a static range and not really expand meaningfully. So that's a very good indicator, and it takes a lot of research and time spent with that idea to integrate it enough that you can trade with the acceptance that, like, this is the logical thing to do at this point. And that's the other thing that comes from a study, DJ, is the confidence that you've seen enough of these things and really understand the nuances around them enough to integrate it meaningfully into the way that you manage your positions.
Yeah, and DJ, one thing I would add with that, you gain, there's one or two ways you can gain experience. You can gain experience through time, repeatedly looking at something over and over and over, but that's usually the longest. The if you're just watching the market, you'll gain experience, but that also takes the longest amount of time to really define the experience you're gaining. The shortest one is specifically looking, actually, I'm going to take a breakout that's and defining the breakout. The more you can define it, the better. And actually looking over several examples, hundreds of examples, and really understanding exactly what you're looking at. One thing that helped me, I knew from the beginning, I like stop entries, I like always in, but I also knew that one of the things I've done hundreds of times is get trapped on the open trying to trade, trying to, in other words, enter before the breakout. In other words, there's two ways. One was kind of as James alluded to, buying the breakout when it might be at the top of the range or it might be touching the moving average and it needs one more bar. And I would often enter there. But the problem was if you weren't fast enough to get out, you would get trapped by the traders that are fading the move because if once a breakout reaches, kind of like yesterday's bar two, it's sold off to resistance, and everybody's kind of waiting at that moment to see, is it going to stall? And if it does, just like what happened on bar four, if you go back to yesterday, because bar three stalled and bar three did not go lower, everybody started dumping, the bears started buying that back their positions, and all the bulls started buying. And the biggest conclusion that I realized, and Al talks about it all the time, is just how much energy it actually takes to really get a strong breakout. In other words, a strong, think about a major surprise that Al talks about. It takes a lot of energy and movement to actually create something that typically is going to get a measured move up. I was looking back at the video course actually yesterday on, I think it was the trading in a trading range video, and it was kind of funny. One of the things Al mentioned was, really, for a breakout to get a measured move, he claims it's barely 60% of the time. Most of the time, those breakouts, they will get second legs, but they're just going to get a small second leg, and you're not going to get a large measured move up of the bar. And what he's saying there, in his way of kind of being a little bit more not exact, he's more of saying it, is most of the time breakouts are in channels or trading ranges where they don't go that far. They get a small second leg and then they go sideways.
Yeah, that's that's really important to remember. I'm actually building a tool for to kind of expand on the breakout code that Ali wrote, so that we can use it in our sessions for SA2 to just kind of generally get statistics on the different types of breakouts that code filters for. And so basically the tool operates on just defining a few input parameters and how many trades it would generate every day and how many of them would meet which measured move targets. And I've it's not complete, so I've only tested breakout and follow through, big bar, breakout and follow through, climax and follow through, and outside bar and follow through. I'm also putting together the single bar setups, but less than 50% of them reach a full measured move target. I think a little over 50% reach a 50% measured move, and over 70% retest the previous swing point. So, the retest of the previous swing point is by far the most logical place for most people to be taking profits and to design a system around that very reasonable expectation, which also kind of validates the research that I did on my trend resumption system initially, which found that you could generally get 1R out of every trade if you took profits aggressively at the previous swing point versus holding for some kind of measured move.
Makes a lot of sense, because you'd have trap traders who scaled in lower interest, and they're going to get out at their original entry.
Exactly. So and this is the way I think I mentioned it here before. What I love about Al's claim that the most important pullback level in price action is 50%, because that's where if you take 50% of a breakout and follow through, or any setup, that's the point at which people are going to be rebuying positions or covering in order to, if they sold the close and then sold higher, and then they're going to be getting out break even at that 50%. And that's where people are going to be adding to positions to get back out. So that's the most logical quote unquote Fibonacci level, because it's not a Fibonacci level. I mean, it is, they use it for things, but it's not any of the kind of enigmatic, whatever decimal Fibonacci levels. It's a mathematically significant level because it expresses a psychological tendency for the way logical traders behave. And so it really, as kind of, again, one of those first principles of market behavior, it really makes sense to kind of anchor a system around that, even if you're not necessarily going to always take profits there. Have your system somehow calibrated to account for that when you're doing your trade management, so that if you're going to be holding, at least monitor how deep the pullback was. So if it doesn't pull back 50%, the odds are that you actually are going to get more of an extension initially, but still unlikely a full measured move. So there's some interesting statistics that you can pull from that, the pullback depth, and that you can anticipate about who's trapped, and like Brad, you were saying, and which direction the always in traders are trading.
That's an interesting I think too yeah, a lot of Fibonacci numbers, they might be meaningful, but how do you really do anything with them? The 50% makes a lot of sense because everything really comes down to risk reward. And when you just look at the market, it's like with anything. If I invest this much, can I get my investment out of it? That's everybody looks at that from that perspective. And when you look at the market, that's generally the most important thing's a breakout. If you're buying the close of a breakout and you put your stop below, the first question is, can I make 1 times my risk? You hear Al talk about that all the time. And one of the biggest mistakes traders make is they end up they too many trades. They have, as we would say, they have half an R or they don't get 1 R. They end up getting far less than 1 R, and their risk exposure is so large that all it takes is, if they lose once, they'll have to spend the next 5 or 6 trades trying to make up that one loss. And it's just a never ending cycle of not going anywhere. The other thing I would say is another important pullback percentage, and I might think about this backwards, but 33%.
Hmm.
In other words, 2/3. So if you have a breakout up to here and you're buying in the bottom portion and your stop is at the bottom of the breakout, that gives you twice your risk to the top of the breakout. So if you have a bull channel, for example, what does Al say in a channel? When you're in a bull channel, the buy zone is, especially if it's more broad, the buy zone is the middle to the bottom 1/3 of the channel. Because if you're buying in the bottom 1/3 of the channel, you're generally going to you have a better risk reward.
Yeah, so that's a good point. So if you can identify the larger either one daily context, if you're in a broad channel, or if you know you're in a trading range, then if you're in the later market cycles, then or a channel that's gently sloped, then buying in that lower 30% is definitely a reasonable pullback location, even for you know relatively even if you're buying into like a what looks like a strong bear leg, until it breaks out from that previous swing point, the odds are that you're going to stay in that channel.
Absolutely. And speaking of channels and just breakouts, it's really important to, as James said, to measure the pullbacks of them, but also to pay attention to, what Al talks about all the time in the course, higher lows. If you look at the 5 minute chart over the past 2 days, the market kept making a higher low and it could never get below the prior higher low. Maybe it did right before the FOMC. I think it might have. It went below one of them. But either
Not
way,
meaningfully.
not many. That's the key point. And when it goes below a higher low, it transitions to a trading range. And then when it transitions to a trading range, it becomes breakout mode. And in this case, we got the upside breakout again. So it's really important when you're in a channel to pay attention, whether it's making lower highs and lower lows or higher lows and higher highs. And if it's not breaking them, that's a clue.
Yeah, and I think the meaningful break is also one of those things that you can watch for. So like when and I don't know that Al talks about. I think I've heard him talk about it, but basically he does talk often about the break of the EMA, the first break of the EMA, and usually you'll get a few bars, but you have the EMA gap bar, and some trade on the other side before the high probability of reversal back to the other side of the EMA. Yeah, I don't know that I've heard him talk about it in terms of other support and resistance levels, so like previous swing points or like daily highs and lows. But at least like in some of the market studies I've collected data on, those levels like previous swing points behave similarly. So that if you don't have like a very strong breakout like you would of the EMA and extension beyond, the odds for some kind of sideways trade before the market's back in breakout mode is much higher probability. And so like today we did go down and test that previous swing point, which was bar 7 low, and there was no meaningful extension. It was just sideways trade there. So
Hmm.
without having a strong breakout, then we're just in a larger trading range, and then you're functionally selling trading range lows if you're selling there.
That's the biggest problem people have. You just said it right there. Is people are willing to sell all the way down to the 7 low. But once it starts to go sideways, nobody wants to sell at the bottom of a trading range. So everyone becomes a little bit more and more, once the momentum starts to dry, everybody starts reducing their position because you're at the bottom of a trading range. They know that if it starts to go sideways, it could go all the way to the top of the range. That's very true.
So yeah, so DJ, that's a good question to kind of frame this conversation around. I think Brad and I are going to try to keep tonight short and sweet, but kind of framing the conversation tonight around how to do studies or what a study should really account for. I think is really useful because I think when most people think about doing about determining which setups they want to trade, they'll go and do a back test, and without really understanding the setup. And the study is that precursor to defining an actual setup, which you could do proper back testing on. And so, the study will often take longer than the back test because the back test is relatively mechanical, and that you're basically collecting all the data for the variables that you've defined and determined to be significant in your study. So like you would never know which variables to actually collect data on and to measure trade performance based on in your back test if you didn't do a strong and kind of first principled study. And so that's how they kind of work together. So I think that's a good thing to leave it with tonight. What do you think, Brad?
For sure. And I'll say one thing. I really can't stress it enough. A lot of people let me I'm going to take a second because I do want to share this just to illustrate a point. These are all the various notes I have from Al, and every one of these is just basically a screenshot of the video course. But the main reason I wanted to bring this up is this is a lot of information, and it's not even a lot of the notes on the books. And the point I'm making is, let me take us back to here. The point I'm making is you can spend a very large amount of time, and it'll translate into years and years and years of trying to take all of that information and put it into a usable format, and you'll end up spending more and more years doing that. So the reality is to take all of Val's information and do it and figure it in a couple of years, I don't think it's possible. And it might be for maybe that 0.5% of people that are just much smarter than others that studied Al. But the reality is the best way to learn something is kind of as James was saying, have a fundamental belief, which is a first principles belief of either breakouts or the market cycle, and figure out what that true, that true core is to yourself, what you truly believe about the market, and then build a study around that and build an actual system, whether it's a breakout in second leg, something breaking through the moving average, because otherwise it's really easy to throw a bunch of pieces. If I take Al's video course and try to apply everything that Al talks about in every possible way you could trade, today, it would add years and years and years to truly being able to do that. So the fastest way really is to understand, how do you build a breakout? How do you build one system and make it work? And nobody wants to hear that. Everybody wants to be Al and trade like Al, but what they forget is there's 30 years of information of a knowledge gap. And just to try and learn 30 years of you can't learn 30 years of information and experience in 1 or 2 years.
Yeah, I think that that's and also, I mean, I think that whenever folks start studying Al, we all want to be him because we see him as one of perhaps the most articulately successful traders. Because there's so many
Sure.
traders who appear to be successful traders and who don't have the humility that Al has and the clarity of thought. And so he's admirable in so many ways that he's just inspiring. And what I think a lot of people forget is that even if we were all profitable to the same degree Al is, and as successful as him, and as humble, we wouldn't trade the same way. And
Bingo.
so, like, I think that it's like we need to remember that the reason why everyone designs a different system is because we all have different comfort levels, things that make us uh, more reluctant to be involved in markets where people are more interested. And for one of the systems I developed, other people would love to trade, and I don't like to trade. And I think that it's easy to admire him to the point where we want to trade like him, when what's better is for us to use the first principles, which he articulates so clearly, to develop the system that's right for us.
Agree with that 100%. And, one thing, last piece I'd say with that is, for me, James, you're not a big fan of stop entries.
I
I
mean,
really
I
like
like
stop
them under the
entries.
right context.
Well, sure, the
Yeah,
right
yeah.
context. And, I probably like more stop entries, even though some of them are a little bit more aggressive. And that's just there's a personality difference there.
Mhm.
Doesn't make it right or wrong. And, you're spot on with what you're saying.
Yeah, exactly. I think that it would be interesting to see folks trading the same system next to each other, and how they probably would even execute it differently,
Absolutely, it
just
would.
simply because of the things that they feel more comfortable doing. So, um, all things that you figure out when you do a study and backtest. So,
Absolutely.
it's a good place to start.
So, with that, thanks everyone for listening, and we will talk to everybody soon.
Yeah, have a great night, everyone.